Let's start this video with a short story about my friend. For the sake of his privacy, let's call him John. Guys, please pay attention to this because I'm sure that most of you all will be able to relate to this story. So John started investing in the markets in 2021 very seriously. He laid his hands on everything that he could under the sky. Stocks in the local markets, stocks in the US market, IPOs, SIPs, cryptos, everything. But in 2022, markets fell. Just like any other retail investors, John started to panic. So to manage his risks, he stopped his SIPs and sold all his stocks. But in 2024, markets again recovered. John came back and started buying again, but this time at higher prices. Now in 2026, after 5 long years, John looks back at his portfolio and says,
I did everything I could. Still nothing.
so where exactly did John go wrong? Why could he not be profitable even after these 5 long years? The problem here, guys, was not the lack of effort of John. The problem here was the way he was thinking about investing. Because investing is not complicated. We complicate it. Warren Buffett once said that The Intelligent Investor was one of the best books on investing ever written. And decades later, he still says that reading this book shaped the way he thinks about money and investing. Just think about this, guys. One of the most famous investors in this world, an ace investor, Warren Buffett. He doesn't credit his victory to those inside informations or any random strategies that he knows about. He credited his victory to how he learned to think. And that's exactly why I am here to tell you that investing is still simple in 2026, provided you get that thinking right. In this video, I am going to break down 5 simple yet extremely important ideas from the book The Intelligent Investor. Ideas that protect you from panic, hype, and costly mistakes. Mind you guys, this is a 650 pages book which most of us would not have enough time or patience to read cover to cover. And in this short video, I am going to cover the core ideas and the real gist that actually matters for investors like you and me. And if you have already made it this far into the video, I'm sure that you're going to stick around till the end. Do subscribe to this channel and like this video because I'm sure that this video is going to make you think that investing is simple, easy, and noise free. Warren Buffett says that price is what you pay, but value is what you get. So what does he exactly mean by this? Let's try to understand this by taking a very well-known Indian stock as an example, Paytm. In 2021, many Indian investors bought Paytm at 2,150 rupees during its IPO. The company was very popular. The app was everywhere. The story sounded big. But by 2023, the stock had fallen over 75%. Did Paytm suddenly become a bad company overnight? No. The problem was not the business. The problem was the price. As a contrasting example, if you consider Tata Motors on the other hand, it was trading at nearly 65 rupees in 2020. People hated this stock. News was negative. Debt looked scary. But the value like JLR turnaround, EV push, global demand, all these were ignored. If you look at the price of this stock in 2024-25, it was trading well above 1000 rupees. Same market, same investors, but different outcomes. So what do we understand from these examples? A great company at a bad price can prove to be a bad investment for you, but an average company at considerably good price can be a good investment. Market will not always reward your activity, it will reward your patience. If you buy the stock of a promising company and sit back, it will turn out to be a good investment for you. Benjamin Graham beautifully explained the markets when he said that markets in the short term is like voting machines, while in the long term, it's like weighing machines. So what does this statement actually mean? When Graham says that market in the short term is like a voting machine, he means to say that the price of a stock in the short term is based on vote and not its value. So where are these votes coming from? These votes are coming from a lot of factors, like what are the investor sentiment looking like? Are they greedy? Are they feeling scared? Or are they feeling excited? What are the headlines looking like? What is the social media narrative about this stock? All these factors. So does these factors actually indicate the value of stock? No, it doesn't. Each buy or sell vote for a stock is saying that I am either interested in the stock right now or I'm feeling very scared to enter right now. But it doesn't really indicate the value of that stock. So these short-term prices which are coming from votes can actually indicate the popularity of a stock. It cannot really indicate the value of a stock. And this company, it can either be overpriced because it's fashionable. Everyone knows about it, like Zomato, Paytm, Nykaa, or it can be undervalued. For example, the Tata Motors stock that we took in the previous chapter. And most of the times, this voting machine based prices of stock can be irrational because the price movement are based on irrational things like emotion, fear, etc. What about this weighing machine concept that Graham is talking about? Over time, market will stop counting these votes and will start weighing the values. Where does this weight come from? Factors like revenue growth, cash flows, what is the future projections looking like, what is the P/E ratio of that particular stock. These are all the important factors which will get weighed in the price. A company that's consistently clocking in great revenues and good profits will eventually see its stock price rising up. And a company that has very weak fundamentals will eventually disappoint you. Let's understand this by taking a quick example of how Indian markets reacted to the rise in interest rates globally in 2022. So in 2022, when the global interest rates rose, Indian IT stocks crashed. Infosys fell from around 1950 rupees to nearly 1350 rupees. Companies like TCS, Wipro all corrected heavily. And all the major headlines said IT is over. AI will completely replace programmers. US recession will kill demand. But by 2025-26, earnings actually stabilized. And again, AI, instead of killing companies, it actually increased the demand. So the emotion and sentiment based price fluctuations we saw in 2022, the voting machine concept, it has actually corrected over time, and now in 2025-26 we can see that stocks of these companies are hitting new highs. So one big lesson that we get from Graham's statement is that in short term, the prices of stocks will indicate the popularity. This is when the traders will actually make money based on the popularity and sentiment. And if you are an investor, you should focus on fundamentals and patience and try to understand the value of the stock in the long run. For this chapter, let's get back to the story of my friend John. He invested in 2021. He stopped all his SIPs and sold his stocks in 22. And then again in 24, he started entering at higher prices. So what does this say about John? Was he stupid? No, that's just human psychology at play. According to multiple AMFI and mutual fund studies, here AMFI is Association for Mutual Funds in India. So it says that average Indian equity investors earn 3 to 4% lower returns than the funds they invest in. So that means if you are investing in a fund that is projected to give you a return of 10%, you are actually getting 5 to 6% only. Why does that happen? Is it because the funds are bad? No, it's because investors usually tend to enter too late or exit too early. SIPs don't work because they are magical. SIPs work only because they eliminate this concept of making decisions. The moment you pause an SIP because you think that the market looks too risky or the market is going down, then you're actually losing the very advantage that SIPs are giving you. What do we learn from this chapter? You don't have to predict the markets. You just have to control your reactions. Right now in 2026, provided that we have infinite number of apps, infinite amount of data and n number of advisors, investing in any sort of assets is just one tap away. But still, a John and many others like him are not being able to get any profits. Why does that happen? There's a saying which goes, if your investments are making your heart beat faster, then that's a warning sign. Most wealth in India are not created out of excitement. Take for example companies in the Indian market like TCS, Nestle, Asian Paints. All these companies did not make money for investors because they came in the headlines every day. These companies were actually quietly compounding their growth, earnings, and revenues. Meanwhile, most of the asset classes which were always on headlines, like the meme coins, the crypto mania, the penny stocks, where are these now? They have destroyed more wealth than they have created. Even right now in 2026, with things like AI, EV, all these, making headlines in every other tech company, remember one thing, that innovation creates opportunities. But valuation will ultimately decide the returns that you're going to get. Invest as if you are buying the whole business. This is the biggest shift an investor can bring in the way he thinks about markets. Stop thinking like a trader. Start thinking as if you are owning the entire business. Guys, take for example that you are planning to buy a Kirana store. So right away, are you going to think about what can be the price fluctuations every day in the Kirana store? No. You guys are going to think about things like what sort of customer base are you trying to reach, what is the competition, what are the number of stores around your Kirana store, location that you are planning to put up your store at. So these are the sort of things that you will consider. In the same lines, stocks are also the same, just that they are digitized. For example, when you're buying HUL, stocks from HUL, this is Hindustan Unilever Limited, you should consider that you are, buying soaps, shampoos, distribution, pricing power. And when you're buying a stock in Reliance, you're buying energy, telecom, retail, and whatever sort of business that Reliance is owning. But one thing that you guys should remember is, when markets are falling, the prices definitely will go down. But the business value of your stock will not disappear overnight. Even Warren Buffett used to say that, analyze and buy stocks as if the market is going to shut down for the next 10 years. Investing is not about being clever, it's about being clear. It's not about predicting the future either. It's about respecting value, patience, and discipline. The rules that worked for Buffett will definitely, for long-term investors in India, work in 2026. Because investing was never complicated. We have made it complicated. If this video has helped you simplify the way you think about markets and investing, please do give it a thumbs up. Subscribe to this channel and share this video with someone who panics during a market fall. I'll see you in the next one. Until then, happy investing.